What if I tell you that while every financial news channel was locked onto NVIDIA, a stock hiding in plain sight quietly turned a modest investment into something almost unbelievable, not in 5 years, not in 3, but in just 12 months? And what if I tell you that same stock just hit $1,000 a share, and the real question right now, just days before a make-or-break earnings call, is whether this rocket still has fuel, or whether the smartest people on Wall Street are already quietly heading for the exit? Welcome back to Smart Stocks Sam, the channel where we cut through the noise and hand you the analysis that actually matters. I'm Sam, and today we are going deep on SanDisk, ticker SNDK. Is it 400% overextended? Are the revised price targets pointing beyond $1,200? And what is the exact trade setup you need before April 30th? We are covering all of it: the technicals, the supply shock, the options data, and the one earnings number that could either send this thing to the moon or trigger a free fall. Let's get into it. To understand what is happening with SanDisk right now, you have to see the raw numbers first, because they are the kind of numbers that make even seasoned traders blink twice. Year to date, SNDK is up 307%. Think about that. In a year when most investors are celebrating a 20% return like it is a championship, SanDisk is delivering that in a matter of weeks. But the true jaw-dropper is the 12-month return, nearly 3,000%. That is not a typo. And we just witnessed the stock print a fresh all-time high of $1,000.02 a share. Since spinning off from Western Digital and shedding its image as a commodity storage company, SanDisk has been reborn, rebranded in the market's eyes as a pure-play AI infrastructure story. And the market is paying up for that story aggressively. But here is the question you absolutely should be asking right now. When a stock moves this fast, this far, is the market seeing something most people are still missing? Or has optimism run so far ahead of reality that the next move down could be just as violent as the move up? So what is actually fueling this? It comes down to three powerful forces converging at exactly the same time. The first is the AI infrastructure arms race. Hyperscalers, Amazon, Google, Microsoft, are not just buying chips. They are building out massive data centers that need enormous volumes of enterprise solid-state drives to feed data to AI processors. Demand has shifted decisively away from consumer electronics and straight into this enterprise AI lane, and SanDisk is sitting right in the middle of it. The second force is what analysts are calling a full-blown NAND shock. Supply has simply not kept up with the explosion in demand, and when that gap opens up in semiconductors, prices move violently. The third force is something almost invisible to most retail investors: the halo effect of related sector earnings. When Intel recently reported a 22% surge in its data center and AI business, traders treated it as a direct green light for SanDisk, sending the stock up another 6% in a single session. That is the power of narrative momentum. And if you think the pricing environment is already extreme, the forecast for the next quarter will make your eyes water. After contract NAND prices surged 85 to 90% in just the first quarter, analysts are projecting another 70 to 75% increase for the second quarter. You read that right. Prices that already nearly doubled are expected to jump again by nearly 3/4 in the following 3 months. This is what a genuine supply-demand supercycle looks like from the inside. SanDisk was confident enough in this environment to announce a 10% direct price hike on April 1st. No joke, no April Fool's prank, a real, hard price increase. In semiconductors, pricing power is the single most important proof of competitive advantage. When a company can raise prices aggressively into surging demand and customers have no alternative but to pay, that is about as close to a monopoly moment as you get in a free market. But there is one development that separates SanDisk from every other NAND player, and it is the reason the valuation multiples have expanded so dramatically. The company is developing high bandwidth flash, or HBF, a next-generation memory architecture specifically designed for AI inference workloads. That is the part of artificial intelligence that actually runs the models in real time, generating responses, processing images, making decisions. By moving into HBF, SanDisk is positioning itself to directly compete with the likes of SK Hynix in a space that was previously dominated by high-bandwidth memory players. Think about what that means. A company the market used to value like a hard drive manufacturer is now competing in the architecture that sits at the very core of how AI systems think. That is not an incremental product update. That is a fundamental identity transformation, and the stock price reflects it. Now add 2 market structure events on top of all that fundamental firepower, and you start to understand why the price action has been almost vertical. On April 20th, SanDisk officially entered the NASDAQ 100, replacing Atlassian. The pre-announcement alone triggered a 12% rally as passive index funds were forced by their mandates to purchase shares they did not yet own. Mechanical buying, price insensitive, deadline-driven, and enormous in volume. Simultaneously, the Roundhill Memory ETF, ticker DRAM, hit $1 billion in assets under management in just 10 trading days. Because SanDisk is a core holding, every dollar flowing into DRAM creates automatic demand for SNDK shares. Passive investing has essentially built a vacuum that continuously pulls stock off the open market. If you have ever wanted to see what happens when exceptional fundamentals collide with forced institutional buying, you are watching it in real time. So, with all of this momentum, you would expect Wall Street to be uniformly bullish. And they largely are, but with a very revealing split that tells you a lot about where we are in this move. The consensus is a strong buy. On the optimistic end, Bernstein and Evercore have targets sitting at $1,200 to $1,250. Bank of America recently reset their target to $1,080. But then, there is Wells Fargo, who raised their target to $975 but maintained a hold rating, essentially saying the story is real, but the risk-reward at these levels is no longer attractive. When the current price is sitting right in the middle of all these analyst targets at exactly $1,000, the market has already priced in quite a lot of perfection. And as any investor who has been through earnings seasons knows, priced for perfection stocks are the ones that suffer the most violent reactions when reality does not quite match the dream. This is where I need you to pay very close attention, because what the chart is showing us right now is technically unprecedented, and understanding it could be the difference between a great trade and a painful one. SanDisk is currently trading 25% above its 20-day moving average. That alone would be considered extreme under most circumstances. But the long-term picture is far more striking. The stock is 400% extended from its 200-day moving average, which sits all the way down at $783, 400%. Think of a rubber band stretched to 4 times its natural length. The physics of financial markets work a lot like that rubber band. The further you pull from the mean, the more violent the eventual snapback tends to be. This does not mean the stock is about to crash. What it does mean is that any disappointment on April 30th, even a slight one, could trigger a mean reversion move that catches a lot of late buyers badly off guard. The momentum gauges add another layer to this picture, and they are telling a story with 2 conflicting chapters. The MACD is at 16.53. That is aggressively bullish, meaning every single dip is still being bought with conviction. The RSI is sitting between 62 and 68, strong and healthy, not yet at that terminal overbought zone above 80 that historically precedes sharp reversals. But the Williams %R is at negative 14.28, and in plain language, that means the stock is critically overbought in the short term. This is not a sell signal on its own, but it is a warning flare. The easy money in this particular leg of the move has likely already been made, and new buyers entering at these levels are taking on significantly elevated risk for a potentially shrinking reward. That brings us to the most important event on the calendar, the April 30th earnings report. Options markets are pricing implied volatility at 113.77%, sitting in the 94th percentile of historical readings. That means option premiums are extraordinarily expensive. The volatility tax to participate is near its highest level on record for this stock. The market is pricing in an expected move of plus or minus 20.7% on earnings day, a $167 swing in either direction. Let me ask you something. Could you sleep through a $167 down move in a single session if you bought yesterday? That question alone should sharpen your risk management instincts going into this week. There are 3 specific numbers that will determine which direction that $167 move goes. First, gross margins, management guided for 65 to 67%. Anything short of that floor will be read as evidence that pricing power is weaker than advertised. Second, data center revenue growth. It expanded 64% last quarter, and the market needs to see that trajectory sustained or accelerated. Any deceleration here would shake the core AI narrative. And third, the moment everyone is watching, the profitability flip. SanDisk has been running a negative net margin of 11% while reinvesting heavily in capacity and technology. This is the quarter they are expected to turn profitable. If all 3 of these boxes get checked on April 30th, that $167 move is almost certainly to the upside. If any one of them misses, even narrowly, brace yourself for the other direction. Now, even if earnings are perfect, there is a structural risk sitting quietly in the background that most retail investors are completely overlooking. Institutions own 82% of the float. That is Vanguard, BlackRock, Fidelity, and their peers. That sounds like a solid foundation, and it is. But short interest is sitting at 7.01%, and the launch of the SNDK 2x short ETF has given bears a new leveraged instrument to hammer the stock intraday during moments of weakness. More importantly, there is a 7.5 million share supply overhang from Western Digital, which still holds a meaningful stake from the spinoff. If they choose to liquidate into the post-earnings strength, and they might, that selling pressure could act as a ceiling that prevents the stock from reaching those $1,200 targets, no matter how good the numbers are. Here is your price roadmap going into the earnings event. Current resistance is the all-time high at $1,002. Above that, you are looking at $1,080, Bank of America's target, and then the psychological boss level at $1,200. On the downside, the first support you want to watch is $947. But the level I have circled in red, the high conviction entry zone for patient buyers, is the $875 range. That is the base of the major bull flag that launched this entire move. And if we get a fear-driven post-earnings flush, that is precisely where the institutional buyers who understand this story will step back in with conviction. If things get truly ugly, the 20-day exponential moving average at $814 is the last line of defense for the entire uptrend. So what is the verdict? SanDisk is the undisputed king of the NAND supercycle. The AI infrastructure tailwinds are real, the pricing power is real, the HBF technology pivot is real, and the institutional appetite is real. But 400% extension from the 200-day average does not get a free pass. Because in markets, that kind of stretch always eventually corrects. We are at maximum optimism, which is historically where the most pain gets distributed to the most recent buyers. Here is my final strategy for navigating this. Do not chase the pre-earnings pump. The options are too expensive, and even if you nail the direction, the implied volatility crush after the number drops will eat a significant portion of your profits. The smarter play is to wait. Watch for the earnings reaction. If we get a sell the news dip into that $875 to $900 support zone, that is your opportunistic entry. Buying disciplined, buying on fear, buying where the risk reward is actually in your favor rather than stacked against you. SanDisk is a generational AI play. Even the greatest rockets need to refuel before the next stage fires. Before we wrap up, and this is important, nothing on this channel constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Smart stock. SAM is for educational and informational purposes only. Always do your own research, Always consult with a qualified financial advisor before making investment decisions, and always understand the full risk of any position you take. Markets can move against you fast, especially in high volatility situations, exactly like this one. Now, I want to hear from you in the comments right now. Do you think SanDisk can sustain its AI premium for the next 2 years? Or is this the beginning of a classic supercycle peak that will fade just like every other one before it? Drop your take below. I read every single comment, and the best insights from this community end up shaping future videos. If this analysis gave you something useful, hit that like button. It genuinely helps more investors find this content. And if you are not subscribed yet, what are you waiting for? Hit subscribe and tap the bell so you never miss an earnings breakdown or trade setup. Finally, if Smart Stock Sam has ever helped you avoid a bad trade or catch a great one, consider showing your support through YouTube's Super Thanks feature right below this video. Every contribution goes directly back into making this research deeper, sharper, and more useful for every investor in this community. Stay sharp, stay disciplined, and as always, invest smartly. I'll see you in the next video.